Okay, let's just jump right in. How on earth do you put a price tag on a skyscraper? I mean, seriously, it's one of the biggest questions in all of real estate. And believe me, the answer is not simple. Today, we're going to dive into the financial model that investors use to figure this out. It's a method that's really part art and part science.
I mean, it's a huge question, right? You can't just, look it up on Zillow. The real value is all locked up in the future, in all the rent that building is going to collect for years and years. So the big challenge is, how do you take all of that future money and boil it down into a single price for today? That's the puzzle we're going to solve.
Well, the main tool for this is something called a discounted cash flow, or DCF for short. Now, I know it sounds super technical, but at its heart, it's really just a storytelling framework. Think of it this way. A DCF analysis lets us write out the financial story of a property's future, chapter by chapter. And then at the end, it translates that entire story into one single number, what it's worth today.
All right, so let's start with chapter 1 of our story. And it's all about profit. See, before we can even think about what a building is worth, we've got to get a realistic forecast of how much cash it's actually going to generate year in and year out.
Okay, so it's kind of like a 4-step journey to get from the pie-in-the-sky income to the actual cash in hand. We start with gross income. That's the dream scenario where every single square foot is rented out. Then we have to get real. We subtract an allowance for vacancy because, let's face it, buildings are almost never 100% full. Next, we subtract all the operating expenses, the day-to-day costs to keep the lights on. And finally, we have to account for capital costs, those inevitable, big-ticket repairs that every building needs eventually.
So what we're left with after all that is a number called unlevered free cash flow. And this is absolutely crucial. Here's why. This number shows you the pure, raw earning power of the building itself, completely separate from any mortgage payments. It tells you how the asset is performing on its own. This number, it's the bedrock for our entire valuation.
Okay, so now we've projected our profits for, let's say, the next 10 years. Great, but here's the next big wrinkle. A dollar that you're gonna earn 10 years from now is not the same as a dollar you have in your pocket today. And that brings us to chapter 2 of our story. We have to account for time and risk.
And this explains it perfectly. Think about it. $100 today. You can invest it, right? It can start earning more for you immediately. But $100 you get 10 years from now, well, you've lost a decade of that growth opportunity, plus inflation has been eating away at what it can actually buy. They are just not the same thing.
So, how do we solve this problem? Simple. We discount it. We apply something called a discount rate. It's just a percentage we use to systematically shrink those future cash flows to figure out what they're worth today. You can think of it as a penalty. It's the price you pay for both the time you have to wait and the risk that, hey, you might not get that money at all. Now, this is where it gets really interesting. The discount rate isn't one size fits all. It's all about risk. Look at this. A super safe, stable building, what we'd call a Class A core property, might have a pretty low discount rate, maybe 6 to 8%. But a really risky ground-up development project, whoa, that could be 20% or even higher. Why? Because the chance of those future profits actually showing up is way lower. So the rule is simple. Higher risk means we shrink those future dollars a lot more.
Okay, so let's recap. We forecasted our yearly profits, and we know how to discount them back to today's value. But hold on, there's one more massive piece of this puzzle. See, most real estate investments aren't held forever. Every story has an ending, and for a property, that ending is the eventual sale. We have to figure out that final payday.
In the world of finance, this is called the terminal value. Basically, it's the giant lump sum of cash an investor expects to get when they finally sell the property, usually about 5 or 10 years down the road. And get this one single number often makes up more than half of the property's entire calculated value. It's huge.
So how in the world do you estimate a sale price that's years in the future? Well, the most common way is to use something called an exit cap rate. You just take the property's final year of projected income and divide it by this rate. The easiest way to think of a cap rate is like a snapshot of the market's mood. A low cap rate means the market is hot. Buyers are willing to pay a premium for every dollar of income. A high cap rate means the opposite. The market's a bit cooler.
All right, this is it. This is the moment we've been building towards, the big reveal. We have all the pieces of our story laid out. We've got the annual profits for the next 10 years. We've estimated that final sale price. Now all we have to do is discount every single one of those numbers back to today's dollars and add them all up.
Okay, first up, we take the discounted value of all the profits from years 1 through 5. And remember, each year's profit gets shrunk just a little bit more than the year before it. So in today's money, that first chunk of cash is worth $2.1 million. Let's put that in the pile. Next, we'll take the profits from years 6 through 10. And see that? Notice how this number is smaller? That's our discount rate doing its job. Because this money is further out in the future, it's worth less to us today, only $1.6 million. Let's add that to our total.
And now for the big one, the grand finale, that massive final sale price. Now, even though it's a full 10 years away, it's such a huge number that even after we discount it, its value today is still a whopping $6.3 million. This is really the climax of our property's financial story.
And now, we just add it all together. The discounted cash from the early years, plus the discounted cash from the later years, plus the discounted value of that final sale, and there it is, the grand total. The estimated value of our skyscraper today is $10 million. Boom.
So there we have it, $10 million. But we can't just stop there. We're not done yet. A DCF, remember, is a story about the future. And well, the future is always uncertain. What if our crystal ball is a little cloudy? What if our assumptions were wrong? We absolutely have to stress test our story.
And this quote really says it all. The model is only as good as your assumptions. It's the classic garbage in, garbage out problem. The final number is 100% dependent on the quality of your assumptions. If you assume rents are going to grow to the moon and that repairs will cost nothing, you're going to get a fantasy valuation, not a realistic one.
And this chart shows that perfectly. Our base case, our most likely story, was $10 million. But what happens if a recession hits and vacancy shoots up? Well, that's our downside case, and maybe the value is only $8.5 million. But what if the market booms? In our upside case, the property could be worth $11.5 million. Any smart investor is going to analyze all three of these scenarios, not just one.
So what this all means is that it's absolutely vital to avoid some common plot holes in your story, mistakes that can lead to a really flawed valuation. Things like being way too optimistic about how much rents will grow, or underestimating how much it's going to cost to repair and maintain the place. And a big one, ignoring the risk when a major tenant's lease is about to expire.
And this all leads to a really crucial piece of professional wisdom. You should never use a DCF in a vacuum. You always have to use it as a sanity check against other, simpler methods. The most common one is just looking at recent sales comps. What if similar buildings in the area actually sold for? If your fancy DCF model spits out $10 million, but everything else is selling for $7 million, you've got a problem. You need to go back and re-examine your story.
Yeah, that simpler method we're talking about is often called direct capitalization. And this slide nails the difference perfectly. Think of direct cap as a quick snapshot. It's a valuation based on just 1 year of income. It's fast, it's useful. But a DCF, that's the full feature film. It tells a much more detailed story over the entire life of the investment. Which brings us to our final and maybe most important thought. At the end of the day, is a DCF really a crystal ball? Not really. It doesn't magically predict the future. What it is, though, is an incredibly powerful and disciplined framework. It forces you to think critically and logically about every single thing that can create or destroy value in a property over time. And it's that disciplined thinking itself that's where the real value is found.